Okay, well, hello everyone, and welcome to tonight's webinar. Tonight we are going to be reviewing module number 4 and answering any questions you have at the end of this module. So this has been a larger module with 5 different lessons, with lesson number 5 being the largest. So I tried to shorten down the review, but was pretty difficult to do, so I'm simply going to fly through most of the slides that you've already seen, just to touch on them very briefly. And if you have any questions, please make sure that you ask those questions, and I will, during the presentation while you think of them, and then I will answer them during the Q&A at the end. I do have 3 or 4 questions here that were sent in earlier that I can also address during that time as well. So let's get started with looking at the lesson 1, which was the buy and hold. And the buy and hold is a strategy that, when I say buy and hold, I'm looking at say long term. I would suggest 5 years or longer. Anything less than 5 years is not what I would call a buy and hold. It's definitely not a flip, but it's something in between, and that can have some tax consequences as well, which you need to be aware of, because in order to take advantage of capital gains exemption, you need to, that only applies to your buy and hold strategies. And the government, if you buy a property for a year, hold it, and then sell it, they may or may not deem that to be a buy and hold strategy, and they may or may not allow you that capital gains exemption. So definitely 5 years or longer is within the buy and hold, and that's why a 3-year buy and hold for a lease option is not a buy and hold, because that was not your plan to hold it long term any longer than 5 years. It was obviously your plan to sell it to the tenant buyer. So that's the difference between long-term, short-term, in my opinion. The buy and hold can apply to pretty much any property, single-family, duplexes, right up to large apartment buildings. And the beautiful thing about the buy and hold strategy is that you get to experience all of the profit centers that are related to real estate. It can also be with any class of building, A being your brand new buildings right down to the C, which are your pretty rough around the edges, and the lower income buildings are your C buildings. One thing to keep in mind, it is a slow and steady strategy. This is not a get rich quick, but the nice thing about it is that it is recession resistant. As I explained during one of the major downturns in the markets, our portfolio actually increased in value because of the increase in demand for rentals due to people losing their jobs, losing their homes. It's unfortunate, but they still need a place to live. I've provided you with a copy of the analyzer that I use. There are many different analyzers out there. You do not have to use mine. This is a very simple 1-page snapshot. I like it because it is very simple to use, and it's not too complicated. It doesn't provide you lots of pages that you have to go through. It's all on 1 page, 1 screen. So this is for larger multi-units. I've also created a version for smaller single-family homes, duplexes. The biggest difference is that there's far fewer expenses related to it. The purchase costs are a little bit different as well. And you'll see that this one has a Canadian flag on it because I have a Canadian version and a US version. I will have a US version for the apartment building analyzer as well. The biggest difference between the Canadian and US version is simply the financing. You'll also see over in the bottom, or sorry, not the bottom, but the left-hand side, halfway down, it says no state selected. So in both the Canadian and the US versions, you can select the appropriate state or province that you're investing in, and the land transfer tax will be calculated automatically for you. The other big difference is how the financing is calculated between the 2 different markets, and it's not a huge difference. So if you accidentally end up using the wrong analyzer, not to panic, because you have to keep in mind that all of your analysis is not a guesstimate, but I mean, it's a range, so it's not an exact science, but that's the biggest difference, is the financing. With the buy and hold, the pros of it, stability, slow and steady. You're not going to get rich quick. That is, it's going to be there forever. You get to enjoy all the different profit centers. Plus, you get the taxable gain, the reduced taxable gain, so the capital gains allowance. The cons about it is, as you're buying it, it's very expensive to buy initially unless you've got a lot of cash. Therefore, your profit per door initially is relatively low. Liquidity is not very good as well, so if you need cash quick, it's very difficult to pull equity out of a property quickly because you have to go through the loan process and or sell the property as well. Also, depending on the province, state that you are investing in most jurisdictions, the tax that is generated from rental properties is taxed at the highest rate possible because they deem it to be passive income. So that's just something to be aware of. Again, this is not to teach you about how to buy apartment buildings. It's just to show you the difference between the buy and hold strategy versus flips and other things. If you're interested in learning more about this, I do have a program called the Apartment Building Wealth Generation Program. It's an online education program as well. Well worth your time to take a look at that. All right, lesson 2, we then jumped into the buy, fix, and sell strategy. And I really wanted to highlight that for many people who love watching these types of shows on TV, you just have to remember that these are for entertainment purposes only. It's great entertainment. It's also great to get some good ideas. However, they are not realistic. The fact that you can take a house and renovate it from top to bottom in 3 or 4 weeks on a fixed budget, it's not realistic, and they've got teams of people working and they're dedicated to that particular project as well, so just be aware of that. Now, the pros of the buy, fix, and sell is that there is a definite high potential for profits. You don't have any tenants to deal with, so you don't have to worry about the landlord-tenant review boards or anything like that. And it's also what we call active income. So as I mentioned earlier, passive income from your buy and holds, it gets taxed at a higher rate. With active income, it gets taxed at the lower rate, especially if you're in a corporation. So inside a corporation, you get to take advantage of the lowest tax rate possible. Now, this is a big one as well. So when you go to move in and renovate and sell, a lot of people believe that it's tax-free money. Well, that's simply not the case. A lot of people will do this, and they'll keep doing it until they get caught, and many people don't get caught and they keep on doing it. What happens is that when if the government ever does an audit, what they'll do is they'll see that, okay, well, you've bought this house this year, you've renovated it and sold it, and you lived in it for a year. Next year you did it again, and the year after that you did it again. All of a sudden you're making $40,000, $50,000 each flip. This is a business. This is not what the program was intended for. The program was intended for homeowners to realize a tax-free benefit when they sold their personal residence. The fact that you're doing flips, selling it for tax-free money, that's what they call tax evasion. And the whole key here is intent. There is actually no time attached to how much time you have to be in there to make it tax-free. A lot of people think there is, but there isn't. The cons of doing it is that your returns are definitely driven by the market. So you could get into a program or into a project rather, with the intent of making $30,000, $40,000, but the market conditions change drastically. Market values drop 5–10%. All of a sudden, your profit disappears. It's also very labor intensive. So if you don't have the fortitude to get in there and get your hands dirty and get some sweat going, then this is probably not the way for you to make a lot of money. General rule of thumb, it's going to cost you twice as much to do the renovations, it's going to take twice as long to do the renovations, and you're going to generate half the profit you were expecting. Now, if your profit after you do that calculation is still pretty decent, then I would move forward with it. The other thing is that it's not passive income either. So you do a job, you can make some decent coin on it, that's fantastic, but if you don't continue doing these flips, you don't have that passive income coming in every year. A lot of people ask, well, how much should I spend when I do a buy, fix, and sell? And realistically, there's no real magic number here. Obviously, you want to spend as little as possible. Your focus is lipstick. You want to get in there. You want to find a property that doesn't need any major capital expenditures. You don't want to start changing windows, re-shingling, moving walls, ripping out walls, and re-drywalling, insulating. You want to keep it as simple as possible. What you're looking for is a dirty, unkept property, a property that does not show very well, but you can go in there, you can get a dumpster in, and just throw everything in the dumpster, rip up the carpets, wash everything down, paint it, new carpeting, new flooring, whatever the case, dress it up. That's all lipstick. That's all superficial. That's what you really want to focus on. Once you get beyond that, you can get into some more capital expenses, and that's going to potentially put you into a different tax bracket. And when I talk about capital versus maintenance, if you change out all the windows, that's a capital improvement. If you reshingle the entire roof, capital improvement. Even changing a furnace is a capital improvement. Technically, that can go either way. If you tear out the entire kitchen and put in a brand new kitchen, capital improvement. Same thing with a bathroom. So these are capital improvements versus repairs. And how you run those through for tax benefits, you need to talk to your accountant about that and make sure they understand what you are doing with that property. So again, it's definitely a capital expenditure. If you got the house right to the studs, if you put an addition on the property, definitely that. If it's an unfinished basement, if you're doing the entire roof, all the windows, the furnace, etc., those are all capital expenditures. And the key here is that this can trigger a sales tax on the sale of this property. So you win, and a good friend of mine actually did this recently, where he bought a property and he spent approximately $50,000 in doing major renovations. That was all materials. His labor was not included in that $50,000. So in total, he probably spent about $80,000 on a $250,000 house, and he took it right down to the studs. New wiring, new plumbing, new insulation. It was like a brand new house on the inside. On the outside, brand new siding, new windows, brand new shutters and shingles, etc. So the only thing that was original was the framing of the house. What he didn't realize is that when he sold this house, that's like selling a brand new house, and in our jurisdiction we have HST. So that's goods and services tax plus provincial sales tax, and that works out to 13% that he has to pay to the government when he sells that property. So that can be a nasty surprise if you don't plan for that. Now, each province, each state has their own tax implications. You need to understand these tax implications before you get involved in these types of transactions. I've also included a buy, fix, and sell analysis. A lot of people, when they're doing these buy, fix, and sells, they don't really take into consideration all of the legitimate costs associated with it. So, for example, you don't take into consideration all of the purchasing, but more so the holding costs. So if you're going to, your plan is to hold it for 3 months, but as I said earlier, it takes you twice as long. It could take you 6 months. So now you've got 6 months worth of mortgage payments. You've got 6 months worth of property taxes. You still have to pay the electricity and the water and sewer hookup. If it's wintertime, you may still have to clear the snow. You've got insurance. Property insurance is going to be about 3 times what it would normally be. So these are all holding costs that a lot of people don't take into consideration when they're actually doing their analysis to see whether it's a good deal for a flip or not. So that's the bottom, or that's the top half of the analysis form. Here's the bottom half of it as well, which focuses more on the selling side. Even if you're planning on selling it yourself, you need to invest some time, money, and energy into doing this. So there's going to be some costs for that. You want to get some professional signage out there. If you're going to be hiring the services of a realtor, you're going to be paying 4 or 5% of the selling costs, and then you've got your legal fees as well. There's also, you can see a section there for income. If it's a duplex, triplex, or something larger that you're actually renovating, it may still have some rent coming in, so you need to take that into consideration as well. So this little analyzer will calculate all of the profit for you, and if it still looks pretty good at the end, then go ahead by all means. Also included what we call a Gantt chart, and the Gantt chart just helps you stay organized, especially if you haven't been involved in doing anything like this before. The Gantt chart is an organization chart which will help when you've got multiple people with doing multiple tasks at the same time. So for example, you can't have Terrence doing cleanup on the outside and doing cleanup on the inside at the same time. So S&C, whoever S&C is doing the cleanup on the same at the same time. So this just helps you. I'm not going to go through this in detail, but this helps you just keep things running smoothly, so you know when and how to schedule different trades to come in at different times as well. This is how the big construction sites run smoothly as well. So you can play with that. The rehab cost tracking sheet is, here's a better blow up of it. Just a good way for you to keep track of your expenses, because it's very easy for your costs to get out of control. You just keep running down to the local hardware store, lumber yard, whatever, to pick up this and that, and all of a sudden the kitchen repair you anticipated costing $800 is morphed into $1,500. So it's good to keep track of all of your costs. Again, so I'm not here to teach you about buy, fix, and sell. I'm just here to enlighten you about the opportunity and to see it as an option when you're looking at different opportunities that may come your way. So just to open up your mind to other options available. All right, lesson 3, we talked about assignments. We talked about what an assignment actually is. Very simply, with respect to real estate, you are not, unless you are a licensed realtor working under a licensed brokerage, you are not allowed to sell real estate unless it is your own piece of real estate. So you cannot facilitate any transactions for anybody other than yourself for your own property. However, what you can do is you can buy and sell the contracts. The contract is not real estate. The real estate is the actual physical property itself. So when a person creates a contract to buy or sell a property, that contract can be sold to another individual. And when that contract is sold to somebody else, it is called an assignment. You're assigning the rights to this contract to another individual for some financial compensation. Pretty straightforward. Now, typically a third party is involved in a contract with the assigner, and the contract is in effect transferred to the assignee. So something else that a lot of people don't realize is that banks will assign your mortgage on a regular basis. Banks don't have an infinite amount of cash sitting in their safe to lend out to people. So what happens is they will create the mortgage documents, and they'll say lend the money out at 3%. They will then in turn group or bundle up a group of these mortgages and sell them to an investment firm, and they'll discount it down to 2.75%, and the bank will just keep that spread of 0.25% on the mortgage, and they're making their money on volume. So contracts are assigned all the time. So we'll talk more about mortgage assignments in Module 5, but with real estate, again, just wanted to make sure I really want to make sure you understand that you need to be a licensed real estate agent to sell real estate, but the actual selling or the assigning the rights to the contract is okay. Now the question is, how much do you charge for that? And there is no magic number. There is no percentage. It really depends upon the deal, the quality of the deal itself, as well as supply and demand. If you have a lot of people looking for a very popular style type of property, and you're able to get that piece of property under contract, and you've got lots of people interested, well, you can have a bidding war. rental properties are a perfect example of that. I myself have done numerous assignments. One in particular was a sixplex. I knew that it would be very popular and easy to assign to somebody else. When I mentioned it to the group of investors at the investment club that I belong to, I had 3 people very interested in it, and I said, well, it's first come, first serve, and I was able to make $6,000 on that assignment deal, and I never owned the property. So it can be anywhere from $500 to a couple $1,000s easily, all the way up. The biggest one I've done is $30,000 for an apartment building. So it is very lucrative. It is relatively easy to do. The challenge is finding the deal, making sure it's a good deal, and then finding the individual who is interested and or willing to buy that particular deal. Assignments can be done on any type of property as well, right from single family homes all the way up to large apartment buildings. It can also be done on options. We've talked about lease options before, and or buy, fix, and sells as well. But you can put a lease option deal together, but you don't want to wait 3 years for that deal to come to fruition. So what you do is you take that opportunity that's going to generate $40,000 profit, and you could sell it to another investor and say, give me $5,000 today and you can have this opportunity for the future. Now, when you do an assignment, you need to put, in the purchase and sale agreement, you're going to put your name or your company name, whatever name you're buying that property in, and you're going to add and or assigns or and or his nominee. This will give you the right or permission to assign that contract to somebody else. You also want to include the clause number 2 there, because that clause is going to simply state that if you assign this deal to Joe Blow and Joe Blow for whatever reason fails to close on it, or there becomes a legal issue between Joe Blow and the seller, then you have been removed from the deal. You are not liable for anything within that negotiation or that contract anymore. So you want to make sure that you've got that clause in there just to absolve you of any responsibility. Now, I've been told by my lawyer that in the province that I live in, we do not need to have and or assigns, because we do have the right to assign a contract to anybody that we wish. However, you still would want to make sure that you've got that clause number 2 in there. So you can confirm with your lawyer whether you need to have the and or assigns or not. I suggest that you throw it in there just to be on the safe side. Now, the biggest challenge is how much of an assignment fee and getting enough time in order to, by the time you put it under contract, then finding buyers for that particular contract. So if you're going to be doing assignments on a regular basis, you're going to want to have a database of potential buyers. So you're always looking for those buyers through your networking. You also want to make sure that you ask for enough time for your diligence. So normally on a single family home, people will ask anywhere from a week to 2 weeks. That's typical. You want to try and stretch that out as much as possible. You can also be totally upfront with them and say that, here, I have no plan or means to be able to buy this property outright. However, what I would like to do is put it under contract and try and sell it to somebody else. Well, they're not going to allow you to do that unless you give them a first refusal clause. And what that means is that they can continue trying to sell it themselves or through real estate, whatever the case, and give you a first refusal, so that if somebody else comes along with as good or not better offer, they'll tell you you've got 48 hours to buy it or walk away. So you can make it a win-win. In order to build more time into the contract so that it gives you more opportunity to find a potential buyer for it, what you can do is what I call stacking of conditions. And the stacking of conditions is where you tie the completion or the start of one condition to the completion of another condition. And these can be a little bit tricky and convoluted. A lot of realtors do not like convoluted offers. They like very clear, concise dates because it eliminates the confusion and possible mistakes, and I get that, so that's going to be a challenge for you. Now, keep in mind that most realtors on a single-family home, for example, will allow 7 to 14 days for conditions, and the conditions are going to be your financing and inspection usually. So to get them to give you 21 days or 28 days is going to be a bit of a challenge. What you can try to do is what I call stacking. So if you see, now this is a more of a commercial clause here, but it's the concept again. So you can see here that I'm asking for all of this information right here to be delivered to me within 5 days. Now obviously you may not have to ask for all of this information. You're going to ask for what is relevant to the property. This is just an example. So they've got 5 days to give me this information. I then have a clause that allows me to have inspections, and I also have inspections. It's plural so that I can have more than one inspection if I want. I then have up to 14 days after receipt of all the documents that I've received. So it looks like I've only got 14 days conditions for my inspection and whatnot, but in actual fact I've got 19 days. And then I'm asking for 30 days after the waiving of all conditions in Clause 3 for my financing. So that's 30 days after the 14 days after the 5 days. So now I'm up to 49 days. But if they take a quick look at it, they might think it's only 30 days. So this is called stacking. Now, it doesn't always get accepted by the agents or the sellers, so you have to be careful, pick and choose when to use this. I'm currently in a deal right now with a student, and we are stacking the conditions for a different reason, but we are stacking the conditions and the timelines, and it is being accepted fine. The assignment contract itself, when you want to assign the deal to somebody else, it's a very simple, plain one-page contract. You complete the contract with between yourself and the assigner or the new buyer. You also put in the amount that you're going to receive for it, when it's all taking place. You both sign it. You then staple that to the original purchase and sale contract. You make sure that the lawyers are all given copies of this as well. And that's as simple as that. So these are the steps. Again, just identifying good deals, getting them under contract as quick as possible. Make sure you have an educated real estate agent willing to work with you. Stack your conditions. At the same time, you're finding a buyer for it, and negotiate your assignment fee. Make sure you allow time for due diligence and collect your fee. And if you aren't able to get a buyer before the due diligence time period expires, you can either ask for an extension or simply walk away and say you can't get financing. And again, this is not to replace the teaching of assignments. This is just simply to help you understand the process of an assignment. So in lesson 5 is when you're going to be given the opportunity to take advantage of this. All right, lease options. Now we've talked about lease options before already, so very quickly I focus on the purchase lease option, where I find the tenant first, qualify them, and make sure they've got the funding, or not the funding, but the down payment, and make sure that they'll be able to qualify for funding in the future, so that their credit is repairable, and make sure that it's going to be a good deal for them. The cash flow on lease options can be very, very lucrative. So for example, you're going to collect an option fee. You're looking for at least 5% initially. You want to make sure that your monthly rent is covering all of your PITI, which is your principal, interest, taxes, and insurance. So if our rent is $1,800, our PITI is $1,400. That means we're collecting the difference times 36 months. The profit from the sale. So in the example before, we bought it at around $300,000. We're selling it for $345,000. The balance owing after 3 years of mortgage payments is down to $209,000, so we're going to collect $136,000. So in total, we've collected $164,000, but we have to return to the buyer, tenant buyer, the original option fee of $15,000, plus we negotiated that we would give them back a credit portion of their monthly rent, which was $7,200. This $22,200 becomes part of their down payment for when they qualify for their mortgage. We also, if we have an investor, and which I always had an investor provide me the down payment, this in the form of a second mortgage, I would pull the money back out, recycle my money. So I'm going to pull out the 57. Oh, got an error there, 56,000. I'm going to also pay the investor an 8% interest over the course of 3 years. The investor's made $13,440. So that means I have to pay out $91,640, and my profit is $72,716. So purchase lease options are very, very lucrative. This is the purchase lease option worksheet, which again, you have received a copy of this. So this will help you do the calculations to show you how much a property will generate for you. You just have to insert your numbers where the blue numbers are, and it'll do the calculations automatically. So there's the $72,716 profit down in the bottom right corner. Signing the deal, how much do I charge? We talked about this already. Supply and demand, the profitability of the property, location, quality of the property tenant. You can also assign the you can also assign the lease options as well. So you can put the deals together and then assign that contract, that deal, to another investor. You can also do lease options not only on single family homes, that's the most popular, that's what you see out there in the market the most, but you can also lease option duplexes, triplexes. You just have to keep in mind, even apartment buildings, you just have to keep in mind that it's only one title that you can do a lease option on. So if you have a sixplex, you can't do 6 lease options. You can only do 1 lease option, assuming the building has 1 title. If the building is condominiumized, it then has 6 titles, you can then do 6 lease options. You can also do lease options on businesses. You can do them on buy, fix, and sells, pretty much anything. This was an example that I shared with you, a property that I purchased for $95,000. We put some repairs into it. We saw the value go up to $130,000, and I was able to finance that at 80% of the after repair value. So we only had $6,000 cash invested in this little duplex. Not pretty, but it cash flows nicely. Unfortunately, one side, unit number 7, is below market rents. Where I live, we have rent control, so we can't increase the rents dramatically unless the tenant leaves voluntarily. And of course, they've got it pretty good. They know they've got a 3-bedroom townhouse for $550,000 plus utilities, so they're not leaving anytime soon. But even so, with market rent on the one side and our total revenue being $15,600, our profit is $2,400 a year. And given that we've only invested $6,000, that's a 40% return. Not bad. However, when we considered doing the lease option, we did it on the one side, number 5. We were able to get above market rents by another $200. So that sort of balanced out the 2 units. So if we were able to get the tenant in unit 7 to vacate and get the market rent up, we would increase our rents considerably. So this was another option, was to do a lease option with unit number 5. We did it with unit number 5, and because we owned the property, we weren't too concerned about a large initial down payment, because if they walked away from the deal, we would just simply hang on to it because it was a good deal regardless. We were focusing more on increasing the cash flow, which is what we did, up to $18,000, same expenses. So now our cash flow went from $2,400 up to $4,800 per year, 80% return. And given that we also received a $2,000 deposit, that means we only had a $4,000 investment now, not a $6,000 investment, which made our return even better. So if the lease option closed out, it came to fruition 3 years in the future, we'd make $40,000 plus the cash flow for those 3 years. We were very happy with that. If it didn't close out, we had the positive excess cash flow that we got to enjoy, plus the deposit. We were very happy with that as well. So either way, we were happy. So again, this isn't teaching you about lease options, just to show you that there are different options out there, because you need to be aware of all the different options. All right, so lesson number 5. So this is the meat of this particular module. What would you do when you're faced with an opportunity? So moving forward, every time you look at a deal, what you need to do is ask yourself, what else can I do with this particular deal? in the past, many people would look at, if their focus is buy and hold, that's what they want to do, just buy and holds, they would see all these buy, fix, and sells, they'd see lease option opportunities, but they would do nothing with them because their focus was buy and hold. And that's great to focus on one strategy. I strongly recommend you do that. Whatever your strategy is, stay focused on that. However, I believe that you should have multiple tools in your tool belt so that when you have an opportunity or you see an opportunity to take advantage of another real estate transaction, you know what to do with it. So what are your options? You know, do you do a buy and hold? Do you do a buy, fix, and sell? Do you assign or flip the deal to somebody else, or do you do a lease option? These are just some of the options, the most common options that you have. Just start thinking about them. Now, a lot of people believe that knowledge is power, and that's true that knowledge is power, but it's limited power because it isn't power until you actually apply it. Now, you go one step further and you add some creative thinking to it. And that's what we're doing here, is we're adding some creative thinking to the knowledge you already have in place. And that's like adding rocket fuel. So if you can get yourself into a mastermind, or even just, you know, with another person, then the creative thinking is going to add rocket fuel and you're going to take off like a rocket. So, for example, when I was running a real estate brokerage out west, what I started to see was there was a lot of young first-time home buyers who couldn't qualify for their homes because of the high price of the housing. So what we started to do was look at other options. So think of an average house at $300,000, down payment anywhere from $15,000 to $30,000, mortgage is going to be $270,000, so your principal, interest, taxes, insurance are going to run approximately $1,650. So there's your single family house, there's your pity. The market rent is $1,500. So right there, a young family is better off to rent a house because it's going to be less expensive than to buy a house, and then you don't have the maintenance or any other headaches and issues. They're also going to need $15,000 to $30,000. So I said, well, what if we find a house that's got a suite in the basement that rents out for $800? Now the young family can afford that house. You can lease out, you can do a lease option to the young family. If they don't have the $15,000 to buy the house right then and there, what you can do is a lease option until they can qualify. The suite in the basement can help them qualify as well. So if they succeed in doing this, it's fantastic. You make an excellent profit. The family is happy as well. If they fail, it's unfortunate for the family, but the good news for yourself is that you're okay because you're still going to make excellent cash flow, plus you still own a cash flowing property in the end. If you own a condo, it's another opportunity to that's not performing well. What are your exit strategies? Moving forward, when you buy a property, let's back up here for a sec. When you're moving forward, when you buy a property, not only do you want to look at other opportunities, but you also want to look, probably more importantly, when you get into a deal. It's not a matter of if you make a mistake. When you make a mistake, and it's okay to make a mistake, don't get scared. When you make a mistake, how do you correct it? What are your exit strategies? You should always have 3 or 4 exit strategies. Absolute minimum 2, preferably 3 different exit strategies. So you buy a condo or an underperforming house. What are your options? Well, the obvious one is to sell it. Well, maybe the market's not good enough to sell it. The market conditions have dropped. So you could do a lease option. You could then hold the lease option, or you could assign the lease option. Or you could sell it with a vendor take-back where you hold some of the financing on it. You make it attractive enough for somebody to buy it and affordable enough for them to buy it with the VTB. You can then sell that VTB to somebody else, to another investor, if it's attractive enough, or you can discount the VTB to sell it to somebody else. So these are options. Now, if you own an 8-plex that's barely cash flowing, again, your option is sell it. You could sell it and hold a vendor take back. You could do a lease option. Well, you could do a lease option on the entire building. You can't do it on the individual units. But you could look at doing a condo conversion. So if you did a condo conversion, then what you could do is you could do lease options on the individual condo conversions, or you could do what one of my students did, and that was to sell 3 of the condos and hold the remaining 5 because now it cash flows. So these are just exit strategies. So here we've got 4 or 5 different exit strategies that will work in the event that this condo does not cash flow. Now, I'm going to share with you a story that really enlightened for me this whole exercise of what I'm going to share with you. But what I'm going to share with you. So my mentor, he was going out and he was going to mentor a new student. And the new student had gone through all of the same programs that I'd gone through. And before he had the mentor come out and spend 3 or 4 days with him, he actually had an opportunity to participate in a really lucrative real estate deal. It was an apartment building, and it was a rundown apartment building. And he made $50,000 on this rundown apartment building. Now, for a first deal, in real estate, making $50,000 through an assignment is fantastic, and it's nothing to sneeze at, that's for sure. However, during the course of the mentoring, the student realized that the $50,000 was good, but he missed out on a lot of other opportunities simply because he didn't have his mind opened up like what we're doing here now to see what the other opportunities were. So that's what we need to do, is open your mind to all the different possibilities and start asking, well, how can I? Is there any other opportunity that I can make money with here? So what if, for example, you have 2 apartment buildings, a 24 unit and a 29 unit sold together, asking over $4 million, you have no cash. What are the options? Well, you can assign that deal to somebody else, put it under contract. You can purchase it with other people's money through a joint venture, or you can just simply walk away thinking, if only I could have. Well, this is an actual deal that I put together. I analyzed it, decided whether it was good or bad very quickly, all within a matter of a day. I made an offer the same day to get it under contract. Even before they were open to showings, I put it under contract without seeing it. I knew where they were. I knew what they looked like from the outside. I did a presentation to my joint venture investors who I knew would be interested in a deal like this. They all said yes, they would be interested, subject to the diligence. So I raised $900,000 from the partners, bought the property. I received financial compensation for doing all the work. I was also able to retain 20% equity in it. So I gave 80% of the equity to the investors, which then allowed me to earn 20% of the cash flow, plus earn 20% of the future equity growth. So over a period of 5 years at a 5% appreciation, which is realistic, my portion of the equity would grow $259,000. My return on my investment was actually infinite. Now this is simply because I look at things differently. I didn't say I can't afford that building, because I couldn't afford that building. I didn't have $900,000 cash. I didn't say, well, too bad, and just leave it at that. How can I? What can I do? So I looked at the different opportunities. The first thing I did was I got it under contract. Then I considered all of my options and I took action. So here's another example. So let's say you've got a property, the list price is $320, sell price is $305, but they need $50,000 cash. The debt is $255,000. So the future price or future value is going to be $370,000. So you could do a sandwich lease option in a situation like this, where you pay this, you pay the seller enough money to make their payments on the debt. You and a joint venture place the $50,000 down as a deposit, and then you find a buyer, tenant buyer, with an option to buy. That's one option, but this can get pretty messy if it doesn't work out, and most sandwich lease options don't work out. So I'm not a big fan of the sandwich lease options. You can also do a purchase lease option, would certainly make more sense. But what I like is the agreement for sale, because you have a written contract with a date for title transfer, but in the meantime you're still able to own and operate the property, but the title stays in the name of the individual. So if you don't have good credit, or you don't have the means or ability to qualify for the mortgage, then this is another way of controlling the property. And in the worst case, with this particular scenario, at the end of the 3 years, if you can walk away from the deal. Depends how you write the agreement for sale. You can have an exit clause in there. But even if you do end up with the property, you've got a property now with $65,000 in equity, plus the tenant's deposit, so you can discount that property dramatically by $30,000 and sell it below market value and make a nice tidy little profit, or do another lease option with another investor, sell the lease option, assign the lease option, whatever. Okay, so I gave you an assignment, and actually just a quick show of hands here. Let's see if I can figure this out. Okay, who actually did the assignment over the period of last week? Raise your hand if you actually did the assignment. I'll give you a few seconds here to respond. Okay. Well, I appreciate the honesty. So one person did the assignment. I'm not surprised. The assignment's there. Please take the time to take a look at it and go through the exercise. What I did was gave you the scenario that you've got $20,000 cash. That's all you have. I gave you worksheets, pages 8 and 12. They were attached in the lessons, and those two worksheets. Let me just grab my copies here. So the whole idea was to figure out, what are you going to do? Are you going to buy and hold, buy, fix, and sell? Are you going to assign it, lease option, or walk away? So in scenario one, we were looking at an older brick duplex located on a quiet street with many recent upgrades. It was an estate sale, must sell quickly, asking $99,900. So, do you buy, fix, and sell the property and make $3,500 quick and easy? Do you buy and hold that property knowing that you're only going to cash flow about $85 per door, which is $2,000 per year? Or you do a lease option of $76,986? Well, I think it's pretty obvious which one is the winner here. You also have the option of just simply assigning that deal to somebody else for $5,000. Well, the obvious one is going to be the lease options for sure. So what does the lease option actually look like? Well, it's a 36-month lease option. The deposit that you receive is $5,000. Monthly rents are $1,500. Your principal, interest, tax, and insurance is $590. So you're going to collect over the course of 36 months $32,760. The sale to the third party, the tenant buyer, is going to be $140,000. The amount you owe the bank at the end of 3 years is just over $69,000, so you're collecting another $70,000 for a grand total of $108,000 collected. Again, you have to pay back the $5,000 to the tenant buyer, rebate the $200 per month, assuming they've made their payments for the 36 months. So you pay them back $12,200. That means your gross income to you, less all expenses, is $95,860. Less the initial down payment that you paid for the property, which is $19,000, so your net profit is almost $77,000. So by far, that is the best option in that particular example. Now, in scenario number two was more of a larger multi-unit. This was a 21-unit apartment building being sold as is by a motivated seller at an unbelievable price of $250,000. So again, do you buy, fix, and sell? Do you buy and hold the property? Do you assign the property for $50,000? Now, assigning that property for $50,000 is pretty tempting, and a lot of people would most likely, go that route. So let's take a look at a couple different analyses. Let me get my notes here. So in this particular case, this is how the property is bought. You can see my mouse here. We're doing 65% financing of the purchase price, so we're getting a loan for $162,000, and then we're borrowing at 12% interest only, $320,000 to do all the other repairs. This may or may not be secured against the property. Most likely is not going to be secured against the property on its own. It may have to be secured against other assets as well. So you now have $482,000 that you've collected. You still need to come up with $8,000 cash to put into the deal. Let's get to the next. Now, jumped ahead. Whoops. Here we go. In this particular case, your cash flow is $15,000. It's actually going to be closer to neutral because this particular property is not going to be cash flowing at a full $149,000 while you're doing major renovations. I believe in the example it said that it was 40% vacant. So during that 40% vacancy, you're not going to be collecting rents. Therefore, your income is going to be dramatically lower. Your expenses are still going to be relatively high, though. So you're actually sitting around cash flow neutral for this year. So then let's fast forward to 1 year later. You now have done all the renovations. The value of the property is $900,000, so you go back and you refinance it even at 60% loan to value. That's $540,000 mortgage, which is more than enough to pay off the $490,000 you borrowed to buy the property and to renovate the property. So you're left with a $50,000 in your pocket, plus you're cash flowing over $26,000 annually. Now, the reality is you can actually refinance that up to 85%, and if you were to go up to 85%, that would give you, sorry, I got some different numbers, that would give you quite a bit more cash. That'd give you another $275,000 cash rather than the $50,000, but it would greatly reduce your cash flow, probably down around $20,000 annually. So it depends whether you want the annual cash flow or whether you want a large chunk of money. And also keep in mind that $50,000 to $275,000 is tax-free money because it's borrowed money, so you do not have to pay any income tax on it. You can turn around and buy another investment property with that money as well. So knowing that, the buy, fix, and sell, you're going to make about $350,000 plus or minus if you were to buy it, fix it all up, and then turn around and sell it. So your profit's going to be $350,000. However, because it's a buy, fix, and sell, it's going to be 100% taxable income. Therefore, after you pay your taxes, you might net around $152,000. If you do the buy and hold, in the example that I shared with you there, you take out $50,000 cash after a year, you've got $26,547 annually. And as I mentioned, that could go up as high as $275,000 with cash flow under $20,000 or around $20,000. And the third option is to assign it for $50,000. So the question is, which one would you do? Well, the reality is this is the one that I did. And this is actually an example of a property that I did do as well. So, and I didn't take out the $50,000. I took out about $150,000 cash from that property, and there was still lots of equity in it. And that was about 7 years ago. And I just took out another $100,000 equity from that property. And with that particular property, I didn't put 1 penny of my own money in there. Therefore, every cent that I earn from that property is an infinite return on my investment, simply because I looked at the different opportunities that were available to me. All right, so in conclusion for tonight, I want to stress that there really is no right or wrong answer here. When you're doing the math, don't get hung up on, well, I didn't get the same numbers as you can, so what am I doing wrong? Well, you may not be doing anything wrong. You may just be making different assumptions than I did, and that's okay. The reality is some of the choices are going to simply be better than others, and you have to decide what works best for you. You know, maybe signing that deal for $50,000, maybe you couldn't wait a year in order to realize $150,000 return plus $20,000 a year annual income. $50,000 to you on that day would have been a lot more beneficial. There's nothing wrong with that. The reality is there's just far too many variables and unknowns to figure out the exact numbers. And this is particularly painful for the engineers out there. And myself, being my background is in engineering as well, and for the longest time it frustrated me because I wanted to know the exact formula and know the exact answer. And the reality is there is no exact answer, so just get over it and get used to the fact that you have to make assumptions and approximations, and also learn to operate within your tolerance margin. What are you comfortable with? Knowing that the final outcome is going to be different than what you expect it is. But is it going to be 50% different? Well, if it's going to be 50% different, that's a pretty large margin. I don't know that I'd be willing to roll the dice on that. But if I'm going to be within 5 to 10% of reality of what the final numbers are going to be, I can live with that. And again, these exercises in this program are not necessarily designed to teach you how to do lease options assignments or anything else. They're designed to open your mind up to new opportunities, to think differently. That's what the whole purpose of this program is all about, is to think differently. All right, so that's it. So I knew this was going to be long. We're almost at the hour now, so I've got a few questions here that I will go through. If anybody has any questions, let me find the question box here. Please feel free to throw your questions in there. And in the meantime, I'm going to answer these questions that were sent in earlier. This is by Jay. I was told that if I live in a house 1 year, then I can sell it tax-free. Well, I already touched on that a little bit, but it's worth reiterating. The key is not how long you spend time in that house, whether it be a month, a year, or 5 years. The key is intent. If the government can prove that your intention was to buy the house, fix it, sell it for a profit, then it's a business. If your intent was to live in the house, renovate it, and live in it as a family home, and then all of a sudden you outgrew the home, or you had to move because of a new job or whatever the situation, then that obviously was not your intent to make a profit on it. Therefore, the profit would be tax-free. But if your intent is to sell it like a business, then it is taxable income. So there is no time frame attached to it. I hear people swear up and down that yes, there is, yes, there is. The reality is there is no time frame attached to it. It's the key word is intent. And also, okay, same person asking, doing a reno. Where I live, we don't have HST, so do I need to worry? Well, I don't know, because I don't know, I don't know where you're calling from or emailing from at this point in time, but you need to check with your accountant. Always check with your accountant before you get involved in a major renovation to see if there's going to be any potential tax implications before you get, you don't want to get caught with that. Brian wants me to expand on the Gantt chart explanation again a little bit. Well, the Gantt chart, I mean, don't get too hung up on it. It's just a tool to help you stay organized. It's, I guess, more for the people like myself, who the engineer type individuals who like to have things structured and timing, but it helps you line up the different trades. So, for example, you can't have the person, if you're doing a major renovation and insulation, the whole bit, so you can't have the person come in and do insulation before the plumbing and the electrical is done. So the plumbing, the electrical have to be done prior to the insulation. The insulation has to be done prior to drywalling. The drywalling has to be done prior to painting. So you can schedule all of these different trades out over a period of a month, 2 months, whatever the case may be, so you can now schedule when they're supposed to show up for their job. Can I assign a contract if I don't have the and/or assigns? I'm going to say I don't know exactly. I was taught when I took the courses that were primarily American-based courses. I was taught you always put the and/or assign in, simply because if you don't have the right to do it. Now, my lawyer recently, within the past year, has made it very clear that in my jurisdiction, we can assign a contract without having that and/or assigns in there. However, I would still strongly urge that you put that clause number 2 in there that we showed earlier tonight, because what you don't want to have happen is, the deal go bad between the person you assign the contract to and the original seller, and then the seller come back and try and sue you or have you close on the deal. You want to be able to wash your hands of it and walk away free and clear. I asked my lawyer, well, to be on the safe side, is any harm putting the and/or signs in after my name anyhow? And he said, no, absolutely not, if you feel comfortable doing that. And then stacking the conditions. Well, the stacking of conditions may or may not work depending on the deal. The easiest thing to do is be upfront with the individual and tell them that your plan is to sign this contract to somebody else. Therefore, I need more time in order to find a potential buyer. And in the meantime, if you want to continue trying to sell it, you're more than welcome to do that. If you can give me a week, and then after the week, if I'm not able to assign the contract to somebody else, I'll keep working at assigning the contract, but you can put a first refusal in there so that you can still try and sell it to somebody else. If they won't agree to that, or you don't think they'll agree to that, then what you can try and do is stack the conditions so that your first condition is for 5 days, 10 days. Your second condition is also for 5 days, but it doesn't start until the first condition expires. So if your first condition is 10 days, your second condition is 5 days, it's now conditional for 15. So they just keep stacking on the previous condition clause. Oh, okay, I got one live question here coming in. Give me a second here to read it. Can I explain the 8-plex condo sale in BC? Can I expand on that? So, okay, yes. Actually, what I'll do is I'll just, what's our time here? Okay. This particular example came from a student that I mentored in BC. And the student was a contractor. He was a builder of high-end homes. These houses were $800,000, $900,000. And so he was very accustomed to building expensive stuff. And what he wanted to do, he had a piece of land in a small community, and he wanted to build an 8-plex. So he had the drawings all designed and ready to go. He had the lot purchased, but when he did the math, it wouldn't cash flow because he was spending too much money on the construction. He was making them too nice. So his options were to reduce the building costs. So when he reduced the building costs, it still barely cash flow, like broke even almost. And it really bothered him to lower the quality of the construction because that's just not how he operated. So he sat with this particular property trying to figure out how to make it work for almost a year. He had taken some real estate courses, then he hired me to mentor him. And I went out to BC and I spent 4 days with him. And this was one of the challenges that he brought up. So over the course of the 4 days, we went through the different scenarios. And the scenario that we ended up with was to go ahead and build the 8-plex and build it to his standards. So he was very happy to be able to do that. And then what we were going to do is we were going to, in BC, they call it stratifying or condominiumizing. So there were going to be 8 individual units, 8 separate titles. So then once he had all 8 units built, he could sell 1 or 2 or 3 units. We didn't know how many units he was going to have to sell, but when he would sell 1 or 2 units, he could take all of the profit and apply that towards the debt that he incurred to build the property. So we figured that by selling 3 of the units, that would pay down enough of the debt on that property that the remaining 5 units would cash flow very, very nicely. So in the end, he would end up with the equivalent of a 5-plex, not an 8-plex, that cash flowed very, very nicely for him. So based on that model, he went ahead and built the property. In the end, he didn't have to sell 3 units. He only sold 2 of the units. and he was able to make enough money on the sale of those 2 units, because it was a really good market at the time, that he was able to pay down the remaining debt so that the other 6 units cash flowed extremely nicely. And he still owns that property to this day. So that's the eightplex. And just, again, it's a matter of looking at things differently, trying to figure out how can I, instead of simply I can't do it. All right, any other questions? That's all I've got here. I'm just going to wait a second to see if there's any other questions come in. Nothing coming so far. All right, well, we're 4 minutes over the hour, so that worked out pretty well. I know it was pretty fast, but again, if there's any questions as a result of this, go ahead and email me at kbeaton@arcarealestate.ca, and I'll answer those questions anytime. Also, we will have another live webinar next week. It'll be for the next lesson. However, feel free to answer or ask any questions at all. Plus, there's also the monthly coaching call that you are all entitled to be on, and that's the second Tuesday of every month. You will receive an email in advance of that reminding you about the call, and during that call you can get on there live and ask your questions, or you can email your questions in ahead of time, and if you can't be on the call, you can listen to the response on the recorded call, which gets posted as well. So it looks like that's it for tonight. So I would like to thank everybody for participating, and look forward to chatting to you next week. Take care.